Most people start investing late. Some never start at all. But Warren Buffett began his financial journey long before he had any formal education or a real plan, just a powerful curiosity and a hunger to learn. His story didn't begin with a breakthrough or an inheritance. It began with trial and error, persistence, and eventually one book that changed everything. By the time he bought his first stock at age 11, Buffett had already spent years dabbling in ideas without direction. He wasn't a prodigy in the traditional sense. In his own words, he dithered away much of his early years chasing charts, flipping through stock tickers, and experimenting with popular investing trends that led nowhere. But those experiments taught him something deeper: the importance of rejecting the crowd's opinion and seeking fundamental truth. This is where his real education began. Not in classrooms, but in public libraries, late nights, and obscure financial reports. Buffett devoured everything he could find on investing, not because someone told him to, but because something inside him wouldn't let him stop. It was a search for clarity in a noisy world, lost in the data before finding the framework. During those early years, Buffett was like many new investors, obsessed with patterns, charts, and stock tips. He believed that small fluctuations in lines and prices might predict the future. It was a game that everyone seemed to be playing, and he played along. But the results were unimpressive. He made no meaningful profit. He realized that being busy in the market didn't mean being productive. And then at age 19, he stumbled upon a book that would become the foundation of his life's philosophy, The Intelligent Investor by Benjamin Graham. He didn't just read it, he absorbed it. And in that moment, everything changed. Graham introduced Buffett to 3 fundamental principles that would reshape not only his investments, but his worldview. These ideas weren't complicated. In fact, they were so simple that most investors overlooked them completely. But for Buffett, they were revolutionary. Principle number 1, a stock is a piece of a business. The first idea was straightforward yet profoundly misunderstood. When you buy a stock, you are buying a piece of a real business, not a lottery ticket, not a symbol on a screen. Buffett realized he had spent years knowing ticker symbols, but nothing about the companies behind them. He could recite that X was U.S. Steel and T was AT&T, but he knew nothing about their management, economic characteristics, or competitive positions. Graham taught him to stop thinking like a trader and start thinking like an owner. This shift in thinking was foundational. Suddenly, the questions changed from what's the stock price today to what is this business worth, and do I want to be in business with these people? Buffett began looking at stocks the way he would approach buying a gas station, a grocery store, or factory. What kind of margins does it have? What's the competitive landscape? Is the leadership capable and honest? This wasn't just about numbers. It was about understanding the economic reality behind the numbers. Principle number 2, Mr. Market is not your guide. The second principle from Graham was even more profound. In Chapter 8 of The Intelligent Investor, Graham introduces a concept of Mr. Market, a manic-depressive business partner who offers to buy your share of business or sell you his at a new price every single day. Sometimes Mr. Market is euphoric. Sometimes he's terrified. His prices make no sense. But here's the beauty. You don't have to listen to him unless it benefits you. Imagine owning a gas station with a partner who shows up every morning offering to buy your share or sell you his based on his mood. That's exactly what the stock market is. Most people treat the market like a teacher. Buffett learned to treat like a servant. They provide opportunities, not instructions. This realization is one of the most important and freeing lessons in all of investing. You don't have to react to every price movement. You don't have to play every day. In fact, the less you react, the better your long-term results will be. Buffett emphasized this point by comparing stock prices to farmland or apartment buildings. These don't fluctuate wildly in price from one week to the next, yet they generate consistent returns. Why should quality businesses be any different? The answer, they're not, unless you let Mr. Market control your emotions. Principle number 3, margin of safety. The third pillar of Graham's philosophy was the idea of a margin of safety. It's a simple rule: don't push limits. If you're driving a truck that weighs 9,800 pounds and the bridge says 10,000-pound limit, you don't take that risk. You find another bridge. Investing should be the same. You only act when the opportunity is so obvious, so clearly in your favor, that you don't need perfection to win. Buffett built his entire empire around this concept. He doesn't invest unless there is a built-in cushion, whether it's a great price, a dominant brand, or a strong competitive advantage. This is not about avoiding risk. It's about managing it with discipline and patience. As Buffett often says, you don't need to be right very often. You just need to avoid being catastrophically wrong. These three principles, seeing stocks as businesses, ignoring Mr. Market's mood swings, and demanding a margin of safety, became Buffett's mental framework. And once he had that, everything changed. But building a philosophy is only half the battle. In the next part, we'll explore how Buffett applies these principles in the real world, how he searches for businesses, evaluates their advantages, and makes investment decisions that have withstood the test of decades. Before moving on, pause for a moment and think about how you approach investing. Are you following a framework or reacting to the noise? If this opened your eyes to a better way of thinking about your money, consider leaving a comment with your biggest takeaway. And if someone in your life needs to hear this, send them this video. You might just change how they see their future. By the time Warren Buffett had internalized the three principles from the intelligent investor, he wasn't just investing. He was building a philosophy that would last a lifetime. While most investors look for shortcuts or signals, Buffett developed a mindset of ownership. He began treating every stock as if it were a long-term private business, not just a temporary position in a portfolio. Now, let's dive into how he applied those principles and build a process for choosing which businesses were worth owning, and which were too fragile, too fleeting, or simply too hard to understand. Investing in businesses, not stock symbols. One of Buffett's earliest insights was that the stock market is full of distractions. Ticker symbols, price targets, technical indicators. All these elements can pull investors away from what really matters, the business itself. He recalls knowing the ticker symbols of nearly every company on the New York Stock Exchange as a child, but not knowing a single detail about the companies themselves. It's a trap many fall into, knowing the code but not the core. Buffett's strategy evolved into this. Study companies as if you're buying an entire business, not just a slice of it. Ask the hard questions. What does this company actually do? Who are its competitors? How durable is its advantage? What does its balance sheet reveal? Who's running the company? And can they be trusted? Instead of reacting to charts, Buffett learned to read 10K reports. Instead of watching CNBC, he dug into cash flow statements. His edge wasn't information, it was interpretation. And here's a subtle but powerful tactic he developed. He preferred to analyze a business before knowing its stock price. Why? Because knowing the price first can bias your judgment. It anchors your expectations and colors your perception of value. By starting with the business, he could determine what he thought it was worth, independent of market noise. Real-world thinking. What would you buy locally? To illustrate this mindset, Buffett used a brilliant thought experiment. Let's say you were given $1 million in 1 week to buy any 3 private businesses in your state. What would you do? He wasn't talking about stocks here. He was talking about brick and mortar, real-world businesses. The kind you'd walk into, meet the owner, inspect the operations, and decide whether they could survive and thrive for decades. You wouldn't buy just anything. You'd spend time studying competitive positioning, checking whether management was trustworthy, and evaluating what the future might look like. You'd pass on car dealerships because of razor-thin margins. You'd skip restaurants because of brutal competition. You'd hunt for businesses with an economic moat, some kind of lasting protection that keeps competitors at bay. And that's exactly what Buffett does in the stock market. He treats it like a directory of private businesses. He doesn't care if a stock is trending. He cares whether the business it represents is durable, profitable, and rationally priced. What makes a business worth owning? There are 3 filters Buffett applies when evaluating whether a business is worth buying and holding indefinitely. 1. Enduring competitive advantage. Buffett seeks companies with a moat, something that protects them from competitors and sustains profitability over time. That moat can take many forms. Brand dominance, e.g. Coca-Cola. Network effects, e.g. American Express. Low-cost operations, e.g. Costco. Patents or regulation, e.g. Moody's. He emphasizes that capitalism is a constant war. If you open a successful restaurant, competitors will copy your menu, hire your chef, and offer better parking. You need something they can't replicate easily. 2. Capable and honest management. Buffett believes in trusting the people running the companies he invests in. He avoids crooks and avoids fools. But more than that, he prefers businesses that are so good they could survive a fool running them. Peter Lynch once said, "Buy a business so good an idiot could run it, because one day one will." Buffett agrees. The strength of the business model matters more than the brilliance of any one executive. Still, when possible, he partners with managers who are competent, candid, and shareholder-focused. That combination of integrity and skill builds long-term value. 3. A fair price. Even the best business can be a bad investment if you overpay. Buffett looks for businesses he understands, with strong advantages at a reasonable price. Not necessarily a bargain, but never a bubble. And here's the important nuance. Buffett doesn't chase low price-to-earnings ratios. He chases value. Sometimes that means paying a bit more for quality. As long as the return on capital is consistent and predictable, he's willing to invest at a premium. He compares it to crossing a bridge. If your truck weighs 9,800 pounds and the bridge limit is 10,000, don't risk it. Instead, find a stronger bridge or wait for the right one to be built. The art of saying no. Another core part of Buffett's philosophy is what he doesn't invest in. He has no problem skipping over entire sectors. If a business is too complex, too cyclical, or too dependent on uncertain variables, he passes. In fact, he said that avoiding mistakes is more important than chasing big wins. He'd rather miss an opportunity than lose capital. And that's why he often studies what to avoid first before deciding where to invest. He even suggests that new investors will be better off with a punch card, 20 punches for a lifetime. Every investment uses up one punch. That mental model forces you to be selective, focused, and intentional. Because in the long run, success doesn't come from making hundreds of moves. It comes from making a few high-conviction bets that compound over decades. Simplicity over sophistication. Buffett has often been criticized for being too simple in his approach, but he sees that as a strength. He doesn't rely on exotic models or complex algorithms. His genius is in clarity, consistency, and discipline. He reads businesses like stories, not spreadsheets. He avoids anything that requires a PhD to explain. And he believes that if something can't be explained in plain language, it's probably too risky to own. This mental clarity allows him to operate with a kind of emotional detachment. He's not immune to mistakes, but he rarely panics. He's trained himself to think in terms of business value, not stock price. And that makes all the difference when markets get rough. In Part 3, we'll wrap up with Buffett's thoughts on long-term thinking, opportunity cost, and the art of patience, and explore how his philosophy holds up today, even in a market driven by noise, trends, and speculation. But before you move on, take a moment to reflect. If you had to invest in just 3 businesses this year and hold them forever, what would they be and why? Share your answers in the comments below. It's always fascinating to see how others think, and your insight might inspire someone else on their financial journey. Everything Warren Buffett teaches, every investment philosophy, every carefully chosen word, boils down to one thing: long-term thinking. In a world that rewards instant gratification and rapid trades, Buffett stands almost alone, reminding us that wealth is built not by being fast, but by being right and staying right. Let's explore how he views patience as a superpower, why opportunity cost is the invisible force behind his decisions, and how his mental framework remains one of the most powerful tools an investor can master today. Thinking in decades, not days. Buffett often poses a simple but profound challenge. If you couldn't sell a stock for 10 years, would you still buy it? This question filters out most modern investment decisions. It forces you to think like an owner, not a speculator. And that's precisely what Buffett does. He imagines owning each company forever, not because he intends to, but because that mindset reveals the true quality of the business. When you think in decades, your priorities change. You care less about daily news and more about economic moats. You stop obsessing over quarterly earnings and focus on long-term cash flow. You ignore trends and seek out timeless value. This shift doesn't just improve your investments. It changes how you view your time, your goals, and your life. Opportunity cost. The invisible investment principle. One of the most underrated forces in Buffett's philosophy is opportunity cost. Every time you say yes to an investment, you're saying no to something else. That trade-off matters. Buffett has billions at his disposal, but he still applies a strict filter. Is this the best possible use of our capital today? If the answer is no, even if the investment is decent, he waits. He's famously passed on high-profile deals because something better might come along. That's not hesitation. That's capital discipline. He knows that mediocre opportunities can crowd out great ones, especially when your capital and your attention is limited. This principle applies to all of us. Even if you're managing a $1,000 portfolio, every dollar counts. Every dollar that goes into a weak idea is one less dollar compounding in a great one. Knowing what to skip is just as valuable as knowing what to pursue. The power of doing nothing. In today's world, doing nothing seems like failure. But Buffett would argue the opposite. Inaction, when rooted in discipline, is a strength. He doesn't chase deals. He waits for fat pitches. He's compared investing to baseball, but with one important twist. In baseball, 3 strikes and you're out. In investing, you can let thousands of pitches pass by and only swing when it feels right. This patient mindset requires emotional control. Markets fluctuate. Prices jump and fall. Panic sets in. But Buffett stays grounded. He knows the value of a business isn't determined by the crowd. It's revealed over time. One of his most famous sayings is, "The stock market is designed to transfer money from the active to the patient." And history has proven him right, time and time again. Simplicity is the ultimate edge. Buffett has repeatedly said that investing doesn't have to be complicated. In fact, simplicity often wins. He avoids the most hyped sectors. He doesn't use advanced algorithms. He reads annual reports, not social media. What makes him different is not access to secret information, but the discipline to stay simple when everyone else is chasing complexity. Most people overestimate what they can do in a year and underestimate what they can do in a decade. Buffett built one of the world's largest fortunes by thinking in decades and acting with rare restraint. He shows us that you don't need to be a genius to succeed. You just need to understand a few principles deeply, apply them consistently, avoid the big mistakes. Let time do the heavy lifting. One final thought, the business of life. Buffett often jokes that he's lucky because investing is one of the only fields where age improves your performance. But the truth is, his principles apply far beyond finance. Think about it. Choose what you understand. Ignore the noise. Focus on long-term value. Avoid unnecessary risks. Partner with honest, capable people. These aren't just rules for money. They're rules for living well. The greatest investors don't just grow wealth. They grow wisdom. And Buffett's legacy, more than any portfolio return, is a roadmap for anyone who wants to live with clarity, purpose, and strength. You don't need billions to follow in his footsteps. You just need the right mindset, a willingness to learn, and the courage to wait when everyone else is rushing. Let this serve as a reminder that the best opportunities in life and investing often come to those who are ready, not reactive. Oh! And before you go, a quick note. A surprising number of people who watch these videos regularly aren't subscribed to the channel. If you made it this far, there's a good chance you found value here. Take a second to check if you're subscribed, and if not, hit that button and turn on notifications. That way, you'll be first to catch new insights when they drop. Sometimes one idea is all it takes to shift your future. Let's keep growing together.